Hello and welcome to Be the Market, the only show in Zimbabwe that dives deep into everything equities, markets and finance. I am Francisca Msheche and we are broadcasting from ZTN studios in Harare. Coming next is First Capital Bank recorded a consolidated operating profit after tax of 22 million for the year ended 31 December 2024, compared to $29.7 million in 2023, with capital levels well above regulatory requirements. Core capital grew 19% to $61 million, maintaining a strong buffer above the 30 million regulatory minimum. Capital adequacy stood at 29%, while a liquid assets ratio of 53% ensured the bank remains well positioned to support asset growth. First Mutual property income increased by 62% to 4.8 million in the 2024 financial year from 2.9 million in 2023, while revenue was up 31% to $9 million from 6.8 million from 2023. Revenue growth was driven by growth in property services income and upsurge in pure US dollar rentals and timely rental reviews. We speak to an expert on the show. Don't go away. Beat the Market. We'll be right back. You're still watching Beat the Market on ZTN Prime. Thank you so much for joining us. First Capital Bank recorded a profit after tax of 22 million for the year ended 31 December 2024, compared to 30 million in 2023. With capital levels well above regulatory requirements, core capital grew 19% to 61 million. Total deposits increased by 45% to $180 million in 2024, while loan portfolio grew by 31% in the year. The bank continued to expand the lines of credit, which now total $50 million. I am now joined by Morgan & Co. Head of Research, Tafara Mtutu, to unpack FCB numbers. Good afternoon, and thank you for joining us.
Good afternoon, Francisca.
So now let's get to it. What is your comment on the overall performance of First Capital Bank?
So the bank did well in its lending business, which is the traditional business of banking sector, the banking sector. But in terms of when you go further down, you look at non-interest income. That figure went down a bit, and that was sort of offset by the decline in the credit loss provisions, and then that was then undone again by the high operating expenditure. So it's a bit of a mixed performance at each level of the income statement of First Capital, but the net effect has been just a slight decline in its net profit.
All right. Also, as you know, the bank recorded a profit after tax of 22 million in 2024 compared to 2023 that had 30 million. What is the major cause?
So there were two things that were in the positive that worked for First Capital, and then there are two things that worked to its detriment. So the positives were, in terms of its lending, they managed to push out more loans compared to last year. And also the interest rates were also higher. So the lending margins, the lending income, all that was up. And then given that there's now more clarity with a stable ZiG and stable exchange rates, the ratio of non-performing loans has been on the low side, and also good credit management. So that has also reduced the line item that really speaks to that. So the expense associated with that has been lower. So those two have been the main positives. But then they had to fend against lower non-interest income, which is really driven by foreign currency related gains. So in the absence of a volatile exchange rate, you tend to have low foreign currency revaluation gains, and that was the case with First Capital. And then to add on to that, there was an increase in operating expenses driven by once-off costs related to the business realignment strategy.
All right. We also know that operating costs remained high. Do you think this was necessary for the bank to go through this?
I think it was necessary. At this point where we are, we're starting to see non-interest income fading away because the things that usually resulted in high net income, which is the foreign currency related gains, are now fading away. So now banks really have to go back and maintain profitability by looking at their costs. So what First Capital is doing is, I think it's the right strategy. It's not the first bank. CBZ has also done that. So some of these banks are going through a realignment, restructuring process where they're trying to cut costs so that they maintain profitability, given that going forward we are likely to see non-interest income fading away.
We also understand that total deposits increased by 45% to 1,780 million in 2024. What does this reflect?
I think it really reflects, to a small extent, the stability that's paying off in the country. We're seeing stable ZIG. A lot of people don't feel the need to actually withdraw money as soon as it comes into their account. We're also seeing a lot more deposits being denominated in the US dollar, and there's no rush to liquidate those funds as soon as they hit your account. So I think those factors have led to an increase in deposits in the banking sector in general.
All right. And also FCB, a loan portfolio grew by 31% in 2024. What do you think of the bank's lending strategy?
There are a lot of banks, generally, they're trying to push out as many loans as they can. That's their traditional way of making money. But because of the tight monetary policy, you're seeing there's so many hurdles that they have to go through before they can release that money. But the good thing is there's been offshore lines of credit that are coming into the country, and a lot of the banks are actually grabbing those offshore credit lines, and then they're just adding a bit of margin and then lending out that money. So that has come as a bit of a reprieve, considering that most of the money that they have, especially as deposits, a lot of that has to be kept with the Reserve Bank in line with the tight monetary policy. So they don't have much leeway in terms of lending out the money that they have in their customers' bank accounts. So those lines of credit have come in at the right time, and they have really cushioned that blow.
All right. The bank's net operating income remained largely flat at $74 million due to fee caps. Explain to us why.
Due to?
Due to fee caps.
So you really can't change the amount of the fees that you charge. These costs are regulated, and it's really difficult to really charge your own figure. Of course, there are some competitive advantages that come into play, but overall, you're quite limited, being a structural sector per se. So with that in mind, it becomes really difficult for you to really change the fees that you charge to the bank, to customers.
We also have the issue of cost-to-income ratio increasing to 63% in 2024. The ratio is expected to improve post-realignment. Do you agree with the bank or not?
So this goes back to the restructuring and realignment. That exercise is also costly. For example, if you're going to retrench someone, you can't just let them go without any money. You have to give them a severance package. So there are some costs that then are carried together with this strategy. I do think that some of these costs that have kept that operating expenditure line high are once off. I think going forward, and we'll be guided by their interim results this year, I think we'll likely see a decline in some of these costs, because when you dig deeper into that line item, most of these costs are not your usual costs. These are once-off costs, and you can just see that there's just a volatile change on that line item compared to the prior year. So I think these are once-off costs, and once they're done with this, I think you can start to see that strategy paying off.
And also, loan loss coverage ratio decreased to 2% in 2024 from 5% the prior year. What's your comment on the loan book quality?
I think right now it's in a position where the quality will improve. The banking sector in general is mostly exposed to the agriculture sector, and what we've seen in the last 2 years have been it's been a challenge, especially for farmers, because they borrow money, they go into the farm, and climate change and erratic climate weather just wipes everything, and then they become bad debtors. But now we're seeing the rains were there in the last season. I think the picture is going to be different now. The farmers will be paying back, and if they can, they'll even pay back all the loans that they took in the prior season. So I think going forward, the loan book quality is going to improve when you're just looking at the agriculture sector alone. But obviously, other things need to come into play. The way they select who to give loans and how to manage their collections, all that then comes into play. And I think they're also on the good side in terms of that.
Okay, we have also seen an increase in total assets across banks. Why is that?
A lot of it has to do with when you look at the growth in total assets. One of the key drivers is the deposits, because deposits serve as a base to giving you the money that you use to then grow the assets. And one of the largest assets that they have is the loan book. So we've seen deposits rising because most of them are denominated in USD, and there's a bit of stability that's allowed more of that cash to sit within the bank. So they're leveraging off that and they're pushing it out through loans. But we're also seeing some assets being revalued because what happens with the financial services sector, they hold on to a lot of short-term assets, and their valuation tends to change very quickly. So I think the stability that we're seeing now, that's also pushing the some assets being revalued, and we're seeing that coming through in all the balance sheets of all the banks.
We've also seen the loan books have expanded. Are we seeing quality lending, or could this expose banks to higher default risk?
There's always been appetite for loans in the country. A lot of companies are looking for debt capital because equity capital is quite hard to come by at affordable returns. So with that in mind, I think there'll always be demand for loans going forward. As for the quality, that then really depends on the climate, the investment climate, the economic climate in the country going forward. If things remain as they are right now, I think we could start to see the aggregate non-performing loans ratio in the banking sector actually, going down a bit. But if that volatility that we saw at the beginning of last year, if it comes back again into the market and it affects the operations of the people that took loans, we are likely to see especially the USD borrowers defaulting on their loans, and that would push that NPL back up.
All right, I want us to talk about the non-performing loan, NPL ratios evolving. How are they evolving in Zimbabwe, and what sectors are most vulnerable?
So most of these loans now, they're now denominated in USD. When you take a much longer horizon, you go back to, let's say, 2018, 2019, 2020. The loans were in ZWL at the time. And because of inflation, the loans you took today, they'll lose their value in the next 3-4 months because of the currency's depreciation. So that the NPL was very low, less than 1% or thereabout. But now the currency has changed. It's USD. Whatever happens to the local currency, that $1 of loan remains $1, and if it has interest, it's more. Whether you try to quote it in ZWG, it's a hard loan. So that becomes quite risky for reckless lenders. So if people take on these loans and they're reckless, it tends to bite them back. And the second thing is these loans, most of them they don't go beyond 2030. So when you take a loan now, you're taking it at a double-digit interest rate figure of around 15 or 18%, and you only have 3 to 5 years to pay back. The repayments that you have to do on a monthly basis, they are quite punitive, and it tends to reason that very few people who make very good margins on their businesses, those ones are in a safe position to pay back those funds. Otherwise, it's quite risky.
All right, still on loans, how much of current bank lending is in USD versus the ZWG, and what risks come with that currency mix?
So at the moment, for First Capital, I think it's more than or around 90%. And I think that also speaks to the rest of the sector, the banking sector. A lot of the loans being issued right now are in USD. mostly because the base, which are deposits, the customers' deposits, most of that is denominated in USD. So that's why we're seeing more of those loans being denominated in USD. And going forward, if this is sustainable and if banks remain profitable with that kind of mix, I think they will have to change, because when you look at the central bank's thrust to de-dollarize, they intend to gradually shift away from the USD to the ZWG by 2030. So I think going forward, it will be imperative for banks to match what they're seeing in their customer deposits with the loans that they are pushing out. So I think going forward, we'll see less USD loans being issued, at least until up to 2030. But we'll start to see ZWG loans picking up on that vacuum. And I think banks will have no option, because they have to match these things. You can't have more USD loans and have Z deposits. That's a bad picture. You don't want a bank to get to that level. So I think they'll just match what they're seeing in their customers' deposits and issue accordingly.
Thank you, Mr. Mtutu, for those updates on FCB. It's now time for us to take a break. Don't go away. We'll be right back.
Dental checkups, experiments, games.
The mixture is making bubbles, and the bubbles have changed color. Our balloon has been filled by carbon dioxide.
We have it all right here on Happy Sprouts. Catch us exclusively on ZTN Prime, DSTV channel 294.
We are a special day today here in Harare. It's the inaugural show of the Phoenix podcast.
The story of Africa is really a story about rising from the ashes.
I'm privileged to be sitting in Dubai, and I'm here today in this city of Hoi An in Vietnam. And he's the Amazon #1 seller of a new book called Take Charge. She's one of the most famous celebrity chefs in Vietnam.
You just have to speak it into the universe. When you say something, the universe listens. God listens.
But more importantly, we're talking about having the ability to believe in yourself. Because if we want to make our children, it's not what we do for them that will make them, but it's what we don't do for them that makes them. If you want to be a global player, listen to the future. You can't become the pill without the irritation.
You have to go through that pressure. It's what's going to make you shine.
Those things that I fell down actually helped me appreciate how to get up again. And every time I got up, I was stronger. Because there's nothing as powerful as an idea whose time has come.
Welcome back to Beat the Market, the only show in Zimbabwe that dives deep into the world of equities, markets, and everything finance. Thank you so much for staying with us. First Mutual property income increased by 62% to 4.8 million in 2024 from 2.9 million in 2023. Revenue was up 31% to $9 million, driven by growth in property services income and an upsurge in pure US dollar rentals. Rental collection rates fell from 85% in 2023 to 75% in 2024. We continue our conversation with Tafara discussing First Mutual Properties. Welcome back once again.
Thank you.
So let's get to our first question right now. What is your comment on the First Mutual Properties results performance?
When you look at the top line, the revenue, they did well. That was quite a good performance. But as you get to the bottom line, there were quite a few some few items that then watered down the earnings that they had managed to gain in the top line. So the net effect has also been a decline in their core earnings.
Okay, as you know, the group's net property income jumped by 62% to 4.8 million, yet revenue only rose 31%. What does this widening gap suggest about operational efficiency?
I wouldn't say it's much to do with operational efficiencies, but taking advantage of the situation in the country. So most of their rentals are now in USD, so it's hard currency, doesn't lose its value. But when it comes to taking care of those properties, the utilities, the bills that you have to pay, those it was beneficial to pay them in the local currency because they were pegged at the official rate. So that really allowed them to just make a benefit in terms of the exchange rate differentials. And because the utilities, those costs, they don't change as frequently as other costs in the informal sector. They managed to take advantage of that. So I think that interest rate differential, I think they really took advantage of that. I don't know if that will persist going forward, though.
All right. Rental income remains the main revenue stream, but project management fees and USD-denominated rentals also contributed to growth. How sustainable is this revenue mix in Zimbabwe's current economic climate?
I think it's sustainable. When you have more of your business coming in from rentals, it's very stable because you already know that for the next 3 to 5 years, depending on the lease agreement, you have a certain amount of cash flows that's guaranteed to come into your account. That's stable, that's not volatile, and you can plan ahead in terms of planning for your business, for your costs. So it's very sustainable from that perspective. And considering that they have more of that in their revenue, it speaks to the sustainability of the business's operations. Project development income, these they're not always guaranteed. In one year you can have a lot of these projects, but in another you can have none of those. So it's quite volatile. But it's good to have as another buffer or a cushion in case something happens to your main line, which is the rental incomes. So as it stands right now, I think that mix is good, and I think it's sustainable.
We also know that despite rental income growth, rental collection rates declined from 85% to 75%. How concerning is this drop?
I think it really speaks to, one, the currency. USD rentals are quite hard to, if there's something that happens, it can be difficult to maintain paying those rentals. But I think a much bigger impact or reason behind that, I think it has to do with the economy. Back then, or before the new central bank governor came into office, there was a lot of volatility, but the currency, or what can I say, money supply was high, and each unit of currency in circulation was moving very quickly. So business activity, economic activity was moving way too fast than was economically sustainable. The new central bank governor came in and he has slowed things down, but it was just just abrupt, just like that. So I think that that stop has also affected a lot of people that were thriving on this quick movement of money. We usually call it the high velocity of money. Now the velocity is slowing down, and I think where someone could make a profit in maybe a week, now it's going to be 3 months, for example. So the money that you need to then pay your dues on time has been affected. And I also think the same has also happened to businesses. Businesses slowed down because government contracts have also slowed down and government expenditure is slowing down. So all these, they are also rippling into the rest of the economy and to people that actually depend on these funds flowing quickly, and they are being affected in terms of their rentals.
All right, Mr. Mtutu, looking at the decline, are there specific sectors or types of tenants driving these areas?
They really didn't specify which sectors has been affected, but I think some of this, when you look at just what's happening in the economy and the type of buildings that they have in their portfolio, you tend to see that a lot of businesses that have been maybe in the agriculture sector, or if you are in the peripheries of the agriculture sector, you'll be affected. If your business was, for lack of a better word, just hustling, you would also be affected. And in terms of their residential portfolio, if you have clients that are in volatile industries or your income is just all over the place, then you would also be affected. So I really can say it's a specific sector, but there are some sectors that have been affected by the stability that we're seeing, and also by the overall climate changes that we're seeing all over the world. And I think all those have rippled into their portfolio.
We also understand that 950,000 was spent on infrastructure maintenance. What's your view on the return on this investment?
It's going to be quite hard to get back, considering that some of these the maintenance bills, the people that can actually do the infrastructure maintenance, sometimes they're not even local. For example, you're looking at elevators. You know, these tend to be, you need an international company to come in and then make the changes, and then they come and then they bill you. And that's the reason why a lot of the CBD properties, you know, a lot of people don't rent beyond the 3rd or 4th floor, because the elevators are not working, and clients are not willing to go all the way to 7th floor on stairs to get to, you know, to purchase your product or your service. So all these things, they tend to come into play, and you're forced to pay these costs to international service providers, because they are the only people that can offer that service, and you also need it in order to maintain your clientele and to have them pay that top dollar that they give in rentals.
While we're still on the infrastructure maintenance, with increased maintenance spending, could we expect a stronger push toward energy efficient buildings as part of portfolio upgrades?
That push we're already seeing that push already. A lot of the real estate on a global perspective is pushing for more green buildings. These are buildings that have a less carbon footprint. So if there are solutions that help them, you know, become greener in their buildings, I think they'll be up for it. If there are ways that can help them reduce their carbon footprint without weighing heavily on their bill, I think it will be even better. But for now, some of these solutions, they are good in terms of impact on the environment, but when you look at the cost, some of them are still quite heavy.
All right. Given the increase in pure USD rentals, do you think the group is well positioned to benefit from continued US dollarization in Zimbabwe's economy?
First of all, I don't think that we'll continue being dollarized. I firmly believe that the central bank is on course to de-dollarize in 2030 if all goes well. But if it doesn't happen and we remain dollarized, all the better for businesses, because it's a much stable currency. We just don't have more control in terms of adjusting interest rates and supply as well as we would want with the USD. But it's for planning purposes and for the purpose of doing business, it's a better currency at the moment. And I think they'll also have, just like with the discussion we had with First Capital, they'll also have to find ways to make sure that the collections remain high, because with USD, it's a hard currency and it's quite difficult. If things go sideways in the economy, you are legally bound to pay back that money. So I think collections can become a challenge going forward if they remain dollarized. And I think that's the key risk that I see going forward for them.
All right, lastly, before we let you go, what are the key risks of sustaining this revenue and income growth in 2025?
I think for right now, the main thing that's slowing their growth trajectory has to be the tight monetary policy. Things have been slowed significantly. And I think businesses like FMP and other businesses in the real estate space will be forced either to cut back on their rentals to ensure that their clients continue to pay, or they'll have to risk the void rates going up. But if they have to choose, I think they'll probably maybe keep their rentals stagnant going forward.
Thank you so much, Mr. Ntutu. Well, that is all that we had for you on Beat the Market. And I'd also like to thank our guest today, Mr. Tafara Mtutu, Head of Research at Morgan & Co., for coming through on Beat the Market. I'm Francisca Msheche, and have a pleasant day.